You're listening to Capital Conversations and the show where the money moves and the deals get made. Every episode, we go deep with the people who've actually done it, the entrepreneurs who've built from the ground up, the investors writing the checks, and the industry leaders who know exactly where the capital flows. We talk business funding, investment strategy, and what it really takes to scale. No fluff, no theory, just straight up insight you can put to work. I'm your host, Glen Gould, best-selling author, business funding expert, and your guide through the funding landscape. If this is the kind of business insights you're looking for, make sure to subscribe so that you don't miss an episode.
Welcome to Capital Conversations. In today's episode, we'll be exploring the world of business funding with insights from industry leaders and experts. Let's dive into today's conversation.
Quick hook. If you want growth capital without giving up more equity or sinking into a fixed bank payment you can't handle, revenue-based financing might be the tool you didn't know you needed. Today, we'll show you when it works, how it costs, and how to negotiate terms that protect your runway.
Joining me is Alex Rivera, partner at Northbridge RBF and a former SaaS founder who used revenue-based financing during a pivotal growth year. Alex, welcome to Capital Conversations.
Thanks, Glenn. Great to be here. I'm excited to walk through the mechanics and the real math so founders can decide for themselves.
Let's start with the basics. Alex, in plain language, what is revenue-based financing and how does it fundamentally differ from equity, a term loan, or things like invoice financing?
At its core, RBF gives a company capital in exchange for a fixed multiple of that capital repaid via a percentage of top-line revenue until that multiple is reached. So instead of a fixed monthly loan payment or selling ownership, you pay more when you earn more and less when revenue dips. That alignment is the defining feature.
So the lender's return is tied to revenue performance, not equity upside.
Exactly. Compare it to a term loan. A term loan has fixed amortization and interest regardless of whether your revenue spikes or falls. Equity gives investors upside and control over time. Invoice financing is tied to receivables, and merchant cash advances can be extremely expensive with limited transparency. RBF sits in the middle, non-dilutive but variable and performance-aligned.
Great. Let's talk history briefly. You were a founder who took RBF. Tell us about that situation and a case study that illustrates when RBF is the right lever.
Sure. I founded a B2B SaaS company with predictable monthly revenue, but we needed $750,000 to double marketing and sales for 12 months. We didn't want dilution at that valuation, and a bank wanted extensive covenants and personal guarantees. We structured an RBF, $750K, 1.6x cap, so $1.2 million total, to be repaid, and a 6% revenue share. Measurement was monthly, with a 90-day look-back for smoothing. That structure preserved ownership and scaled repayments with revenue. In year one, revenue grew 2.3x, and the note paid back faster than the base model, freeing us for our next equity round with a stronger narrative.
Walk me through the term sheet items founders should focus on. People throw around multipliers and revenue share rates, but what do those actually mean in practice?
Key levers: the principal amount, the repayment multiple, or cap, the revenue share percentage, any minimum monthly payments or floors, measurement period, and covenants. The repayment multiple, often 1.2x to 3x, determines the total dollar amount the lender expects. The revenue share sets the slice of top line that flows to the lender each period. Floors protect lenders on slow months, and caps limit total cost. Also watch for look-back rules and seasonality adjustments. These define timing and cash flow impact.
Let's do sample math. If a company takes $500K with a 1.8x multiplier and a 7% revenue share, how should a founder model repayment across scenarios?
Start with 3 scenarios: downside, base, upside. Total repayable is $900K. If monthly revenue is $100K and grows 5% per month, a 7% share is $7K this month. You can model monthly shares forward, accumulate until $900K is paid. In a base case, that growth path might repay in 24 months. In downside, flat revenue, it stretches longer and cash strain increases. Upside repays faster. Always model IRR equivalent and compare to what equity dilution or a bank loan would cost over the same horizon.
Which business profiles are the best fit for RBF, and where does it make little sense?
RBF favors predictable, recurring revenue models with healthy unit economics. SaaS, subscription services, some e-commerce with repeat customers. High gross margins help because you're sharing top line, not just profits. It struggles with early pre-revenue startups, highly seasonal businesses without proper seasonality adjustments, or very low-margin businesses where sharing revenue materially harms cash available to cover costs.
Underwriting. What signals do RBF lenders look for during diligence?
They look at LTV of customers, churn, gross margins, CAC payback, historic revenue volatility, and quality of financial reporting. Lenders want clean, auditable revenue. They stress test seasonality and look for working capital levers. If your books are messy, expect higher cost or more restrictive covenants.
Negotiation time. Founders often fear hidden traps. What are common red flags in RBF term sheets, and what scripts should founders use to clarify them?
Watch for vague revenue definitions, aggressive minimum payments, step-in rights that allow the lender to control collections, and clauses that accelerate repayment on change of control without reasonable caps. Can you define allowable revenue for measurement and confirm any adjustments for returns or refunds? Then, what triggers minimum payments or acceleration, and can we add seasonal smoothing for the first 24 months? Always ask, show me a modeled repayment under our downside case.
How does RBF interact with future equity rounds? Will it scare investors or complicate cap tables?
Smart VCs expect some non-dilutive debt on the cap table. The problems arise if the RBF accelerates on change of control or carries a very high effective cost. Best practice? Negotiate clear repayment caps, no punitive acceleration on future fundraising, and transparency on how repayments will be accounted for in acquisition scenarios. Tell future investors how RBF helped you hit milestones. That narrative can actually strengthen a raise.
Let's give founders a short playbook, step-by-step, and a checklist of models to run before signing.
Playbook in 5 steps. 1. Clean your revenue reporting. 2. Run 3 scenario repayment models, downside, base, upside. 3. Request a draft term sheet and highlight ambiguous clauses. 4. Negotiate caps, seasonality smoothing, and measurement windows. 5. Compare effective cost to equity dilution and bank debt on a multiple or IRR basis. Checklist. Monthly recurring revenue trend, gross margin by product, CAC payback, bank covenants, customer concentration, and pro forma cash flow showing RBF outflows. Any scripts to start the conversation with an RBF provider or your board?
With a provider. We want a financing structure that scales with revenue and preserves equity. Can you show us modeled repayments under our 3 scenarios and specify any minimum monthly obligations? With your board. This option preserves founder control, buys 12 to 18 months of growth runway, and our modeled downside keeps cash positive. Here are the sensitivities. Before we wrap, what's one mistake you repeatedly see founders make with RBF?
Underestimating revenue volatility and not stress testing for a slowdown. They sign a rate that looks fine on growth, but a small dip can stretch repayments and strain operations. Model conservatively and negotiate seasonality or floor protections.
Excellent. Quick recap. Your top 3 actionable takeaways for founders weighing RBF today?
1. Model 3 scenarios and prioritize downside cash flow. 2. Negotiate clear definitions, revenue, measurement period, and seasonality. 3. Compare effective cost to equity and bank debt using a common metric like IRR or multiple of capital. If you enjoyed this episode, hit subscribe on your podcast player so you don't miss future conversations on funding strategies. Alex, thanks for sharing practical frameworks and scripts. Very helpful.
Thanks for having me, Glenn. If listeners want templates or a sample term sheet, check the episode notes. We included a simple modeling spreadsheet and a negotiation checklist.
Thank you for joining us on Capital Conversations. I hope today's discussion provided valuable insights for your funding journey. Remember, securing the right capital is a crucial step in building a successful business.
Keep building. Let's talk capital. Until our next conversation.
That's a wrap on today's episode of Capital Conversations. And if you got value from this, do me a favor, share it with one person who's in the game or trying to get in it. That's how we grow this community. If you're ready to take action on your funding, go to glenhasmoney.com and let's talk about what's possible for your business. I am Glen Gould, and we'll be back next week with another conversation worth having. Until then, keep building, keep pushing, and go get your capital. Capital Conversations out.